Strategy Management Series. Video number 69, Strategy Formulation. Step 6, Strategy Selection, BCG Matrix. Welcome back to the Ready MBA series on strategy management. In our previous videos, we have been discussing strategy selection, the sixth step in the strategy formulation process. This step consists of identifying and selecting courses of action that a company may choose to achieve its strategic intent, mission, vision, and objectives. To help define those, the planning team can leverage generic strategies and strategic frameworks. Generic strategies are fundamental approaches that businesses adopt to gain a competitive advantage and position themselves effectively within their industry or market. Strategic frameworks are analytical tools that help the planning team visualize the specific conditions in which the company finds itself, and based on their results, enable the company to identify potential strategies to be executed. In our prior episodes, we covered different groups of generic strategies such as Porter's generic strategies, diversification strategies, integration, cooperative and acquisition strategies, as well as restructuring and disruption strategies. These generic strategies help businesses make strategic decisions about how they will compete in the market, allocate resources, and differentiate themselves from competitors. In this video, we will start reviewing different strategic frameworks to identify the most appropriate generic strategies to be considered by the planning team given internal and external market conditions. One of the frameworks commonly used for strategy selection is the BCG Matrix. Let's explore it together. The BCG Matrix is a powerful tool for analyzing a company's portfolio of products or business units. It can be used at the company, division, and product level. It helps us understand their relative market share and market growth rate, which are crucial inputs for strategy selection. The BCG Matrix is configured as a 4-quadrant grid. On the vertical axis, we have the market growth rate, which indicates how fast the industry is growing. If you are plotting multiple divisions or products in the same matrix, each one of them should consider their respective market growth rates. And on the horizontal axis, we have the relative market share, which shows the business unit's market share compared to its competitors. Relative market share in the BCG matrix is a measure of a product's or a business unit's market share relative to that of its largest competitor in the same market. The midpoint of the axis would be of 0.5, meaning 50% of the market share of the largest player in that industry. Let's start with the first quadrant, question marks. In this quadrant, businesses have a low relative share position, yet they compete in a high-growth industry. These are business units or products with high cash needs and low cash generation. Organizations must decide whether to strengthen these question marks by pursuing an intensive strategy. Intensive strategies included market penetration, market development, or product development. These are all strategies focused on growing market share using different means to get there. When executing market penetration strategies, the organization focuses on increasing market share with existing products. It generally involves promotions and pricing strategies, client loyalty, and any other tactics aimed at driving more sales. Market development involves entering new markets with existing products. It's all about expanding the size of the addressable market for the company. In product development strategies, new products are introduced to existing markets. This includes leveraging brand extensions, existing capabilities, and other synergies to capture incremental share in a cost-efficient way. The three preceding generic strategies are expansive by design and are recommended when the planning team is confident that the company possesses competitive advantages, favorable market conditions, or a combination of both, which will contribute to driving growth and achieving success. However, when such conditions are non-existent, a divestiture could be a better course of action. Divestiture is the option to sell off or discontinue the business unit, the division, a specific product line, or single product. For example, imagine a tech startup that has developed an innovative product but faces intense competition. To strengthen their question mark, they may focus on market penetration by increasing their market share through aggressive marketing and competitive pricing. They could also explore market development by entering new markets or product development by introducing new features to meet evolving customer needs. In some cases, if the business unit isn't showing promise, the organization may consider divestiture, selling off the unit to allocate resources elsewhere. Moving on to the stars quadrant. In this quadrant, businesses have a high relative market share and a high industry growth rate. Stars represent the organization's best long-run opportunities for growth and profitability. These business units or products have strong market positions and require substantial investment to maintain or strengthen their dominant positions. Strategies for stars include backward, forward, or horizontal integration, which involve expanding through partnerships, acquisitions, or diversification, respectively. Additionally, they can employ market penetration, market development, or product development strategies to further enhance their market position. Let's take an example of a star, a leading smartphone brand that has gained a significant market share. To leverage their star position, they may pursue backward integration by acquiring suppliers to control the supply chain. Forward integration could be an option too, by acquiring distribution channels to have a direct reach to customers. Horizontal integration, such as merging with or acquiring competitors, could also be considered. Furthermore, they can continue to grow by employing market penetration strategies to capture more of the current market, market development by expanding into new geographic regions, or product development by introducing new features or variations of their smartphones. Now, let's talk about cash cows. Divisions in this quadrant have a high relative market share position but compete in a low-growth industry. These are business units or products that generate more cash than they require. Cash cows are often milked, meaning they are managed to maintain their strong position and profitability for as long as possible. Strategies for cash cows include product development, where new offerings are introduced to the existing market, and diversification, which involves expanding into new markets or industries. These strategies are most suitable to situations in which there are still promising perspectives for the business, and no immediate serious threats or challenges that could harm the business. Retrenchment strategies focus on cost reduction and operational efficiency, and they could also be considered when market conditions for cash cows start changing, such as with decreasing demand, increasing competition and margin erosion. Divestiture, which is the option to sell off or reduce investment in the business unit, could also be considered, if the long-term perspective does not look so promising with market saturation, technology disruption, or external economic challenges. Divestiture is also an option when there is a change in the company's strategy and priorities that no longer justify maintaining the division, but that can lead to attractive proceeds from selling the business, especially considering its cash generation potential. Consider a well-established consumer goods company with a flagship product that dominates its market. To sustain their cash cow, they may invest in product development to enhance their existing offerings, explore diversification by entering new markets or industries, or focus on retrenchment to optimize costs and improve efficiency. Divestiture could also be an option if the business unit is no longer aligned with the company's long-term strategy. Lastly, we have the dogs quadrant. In it, divisions of the organization have a low relative market share and compete in a slow or no-growth industry. Dogs are business units or products with weak internal and external positions, often resulting in low market share and slow growth. Organizations may choose to liquidate, divest, or trim down these units. Strategies for dogs include retrenchment, which focuses on cost reduction and restructuring, divestiture, where the business unit is sold off or discontinued, and liquidation, which involves shutting down the unit entirely. Let's imagine a declining division of a retail company that operates in a saturated market with strong competition. To address the dog, the company may opt for retrenchment, implementing cost reduction measures and restructuring to improve profitability. Divestiture could also be considered, selling the underperforming division to focus resources on more promising areas. In extreme cases, liquidation might be the only viable option. It's important to note that these strategies are not fixed or exclusive to a specific quadrant. Depending on the organization's objectives and market dynamics, strategies can vary. Before we wrap up, let's discuss some limitations of the BCG matrix. Firstly, the matrix lacks temporal qualities, as it provides a static snapshot without considering industry growth over time. It's also essential to consider other factors like market size and competitive advantages, which play a significant role in decision-making but are not considered in the BCG matrix. Additionally, when plotting divisions on the matrix, some may fall in the middle, making them challenging to classify. In such cases, more nuanced and supporting analyses are necessary. And that concludes our discussion on strategy selection using the BCG matrix. We hope this video has shed light on how organizations analyze and select strategies for their portfolio. As always, thank you for watching, and don't forget to subscribe to our channel for more educational content on business strategy. See you in the next video.